If the investor's time frame is short, I think that the gold stocks and the silver stocks have to catch up to the gold price and the silver price. I think we are in a conventional precious metals bull market, which is led by the metal. To the metal, the best of the best follow, and then the best of the rest follow. So if the investor is asking me the question from the point of view of a 1 year time frame, I think the gold and the silver equities are likely the place to be. If you look out further, for every reason in the world needs more types of power of all types. And copper is how you get it. Well, it's how you generate it. It's how you get it from where it is to where it's needed, and it's how you use it. There's 1 billion people on Earth with no access to primary electricity. Those are all copper buyers, whether they know it or not. And we all want to use more energy. It makes our life better.
In recent months, the precious metals sector has staged a quiet yet remarkable rebound. Gold prices have surged to new highs, silver is following close behind, and copper, often considered the bellwether of global economic health, has begun to show signs of structural strength, while broader equity markets continue to flirt with artificial highs propped up by central bank interventions and speculative capital. The commodity sector is quietly positioning itself for a generational breakout. The metals aren't just responding to inflation or geopolitical risk, they're responding to a deeper, long-term realignment of industrial demand, supply constraints, and monetary revaluation. And for those paying attention, this silent shift spells opportunity. In this episode, we feature insights from two of the sharpest minds in the resource investing space: Lobo Tiggre, founder of IndependentSpeculator.com, and Rick Rule, legendary investor and former CEO of Sprott U.S. Holdings. With decades of combined experience navigating bull and bear cycles in commodities, their perspectives cut through the noise to deliver actionable intelligence. Lobo opens with a bullish thesis on copper, highlighting structural deficits, geopolitical triggers, and near-term buying opportunities. He cautions about volatility ahead, but maintains that the long-term upside remains intact. Rick Rule, ever the disciplined pragmatist, complements this view with a broader reflection on timeframes and investor temperament. While he echoes Lobo's enthusiasm for copper, he also spotlights the near-term potential in gold and silver equities, which are still lagging behind their underlying metals. Rule underscores a critical truth: in commodity bull markets, the biggest gains often come not from the metals themselves. However, success in this space is far from passive. It requires diligence, discipline, and a sharp eye for value amid a sea of hype. So whether you're a long-term commodity bull or a tactical investor looking for entry points, this video offers a masterclass in strategic positioning. If you find value in this kind of data-driven, no-nonsense analysis, be sure to like this video, share it with other market-focused investors, and subscribe for more in-depth commentary from the front lines of the global resource trade.
Areas of the commodities sector at present do you think presents the greatest value proposition, and how are you positioning yourself to capitalize? Lobo, I'll start with you.
I'm going to have to go with copper. That's been my top call for 2025. And people have been wrongly congratulating me on that because copper hit an all-time high earlier this year, but not for the reasons that I gave. So maybe you should stop listening to me then. But I think all those reasons I gave are still in front of us, and going into that from a higher cost base or a price level, I think that just adds to the upside. And the thing that I like about, I mean, I'm bullish on many things. I could, other metals and minerals are high on my list. But the thing that I like about copper is that it really is straight. The structural supply constraints here are so real, so big. That pipeline is so close to dry for years and decades to come. It's just an extremely strong thesis. And I think we're getting to that push comes to shove moment. My only concern is in the very near term, we still have plenty of trade war issues, actual war issues, Trump shock ahead to deal with, and Dr. Copper is economically sensitive. So I think there's potential for near-term weakness, which I would absolutely see as a gift from Mr. Market, a buying opportunity, and I am saving up cash for that.
And really quickly before we move on, why did copper hit all-time highs, and why did that not align with
for the
thesis?
wrong reasons? Trump didn't even announce a copper tariff. He announced, he signed an executive order. We're going to look at copper. We're going to study it. Oh, great. You remember when they studied uranium? That took years, and then they did bupkis. Sorry, but the fact is it was actually Biden that implemented the Trump study group idea of uranium, of establishing that uranium reserve, and funded it, or started it anyway. So, a study group doesn't excite me. And maybe it's a coincidence, but that's all that really happened in the market at that time. What's happening now, I think, is more real. It's got more of my attention. I'm still worried about Dr. Copper in the nearest term, but when the LME stocks go, way down, and China's having to, trouble getting its smelters to work right. I mean, they're very excited because they just got to zero smelting charges. That tells you something about the market. So I'm really, really very keen, and I don't claim to be able to time the market. I just have this feeling, though, that the time to buy is in front of us rather than behind us. If I'm wrong, I'll still have years, I think, and decades to make money on this trade. If you're very patient and you can handle the kind of drawdowns that have resulted in Rick having less hair than me at this time on the way. Rick will tell you all of my big wins have had 50% drawdowns on the way. If you can handle that, and you think copper is likely to, the bottom is behind us, then don't wait for me. Go ahead. I think that is so solid that I would go ahead. But it's Dr. Copper. I just can't get it out of my head that the other shoe is yet to drop on the retooling of the American economy that the president is trying to ram through. And that will have consequences that I think will create a buying opportunity.
And Rick, what are you watching the most right now when it comes to the commodity sector? What do you think is presenting the greatest value proposition?
The answer to the question is really a function of the investor's time frame. If the investor's time frame is short, I think that the gold stocks and the silver stocks have to catch up to the gold price and the silver price. I think we are in a conventional precious metals bull market, which is led by the metal. After the metal, the best of the best follow, and then the best of the rest follow. So if the investor is asking me the question from the point of view of a 1-year time frame, I think the gold and the silver equities are likely the place to be. I'm not positioning there because I'm positioned. I have this paper coming out of every available orifice, horrible image, but that's the way it is. I agree a lot with Lobo with regards to copper. I like the copper business because there's any number of copper mines in the world that make $2 or $3 million a day. And I have a fondness for big, big, big deposits as opposed to small deposits. The copper business has treated me extraordinarily well for 40 years, so I'm predisposed to it. I'm a bit more cautious than Lobo, which is unusual, in the near term about the economy. I'm not an economist, but I note that the oil price falls even on flat oil production. That tells me something about near-term demand in the economy, not what people are looking to in the future. But I would agree with Lobo that to the extent that we see copper weakness as a consequence of the global economy, that we view this as a gift. If you look out further, for every reason in the world needs more types of power of all types. And copper is how you get it. Well, it's how you generate it. It's how you get it from where it is to where it's needed, and it's how you use it. There's 1 billion people on Earth with no access to primary electricity. Those are all copper buyers, whether they know it or not. And we all want to use more energy. It makes our life better. My own particular thesis is that I'm a commodity agnostic. I like great big deposits, tier 1 deposits, sort of $20 billion in net present value at today's prices, in recoverable reserves and resources. And I don't care about the commodity. What that means is that I'm looking at tier 1 deposits in out-of-favor countries in out-of-favor commodities. Things like rare earths in Brazil, things like rutile and graphite in Zambia. 6 months ago, before it became popular again, platinum and palladium in Brazil. I have a huge fondness for great big deposits in out-of-favor commodities, in out-of-favor countries where the market ignores it. The idea that there is a deposit that could in 5 years be worth $2 or $3 billion that has a market cap of $50 or $60 million today is particularly seductive to me because I've enjoyed it so often in the past.
Good questions, but let me jump in on this gift point because I think this is really important. It's something that Rick and I have both seen in our careers. And we've had a recent example And that was in the uranium space, another area that I know Rick and I agree on. When uranium sort of bottomed out recently, and the stocks they held up because the uranium story is so strong. Everybody sees it. The demand case is so high. Even skeptics have so the uranium stocks were kind of holding up, even though spot uranium was going down. And then that DeepSeek thing came out of China, and everybody's, oh my gosh, AI is not going to need all this energy. And uranium stocks cratered. That was absolutely a gift. I mean, it was a sell-off for completely the wrong reason. Uranium went up to 80, 100, before the AI craze kicked into high gear. The AI story was never the reason for owning uranium stocks. It became an purely optional bolt-on tailwind at some point, and its disappearance made no difference, none, zero whatsoever to the investment thesis for this still necessary, no substitution. Sorry, thorium fans, not anytime soon, right? You've got to have it, or as Rick says, the lights will go out in large swaths of the world, and it goes on sale for completely hype-driven wrong reasons. An absolute gift.
Lobo Tigre's bullish outlook on copper is rooted not in recent price spikes, but in structural fundamentals that remain largely unaddressed. While copper hit an all-time high earlier this year, Lobo warns that the market rally wasn't driven by sound fundamentals, but by speculative noise, particularly policy signals from Washington that so far amount to little more than executive orders to study copper. He argues the real catalysts, supply constraints, energy infrastructure demands, and geopolitical disruptions are only just beginning to unfold. With LME stockpiles dropping and smelting disruptions in China, the physical copper market is flashing clear signals of stress. Importantly, both Lobo and Rick frame any near-term weakness in copper prices not as a risk, but as a gift. Given copper's sensitivity to global economic health, volatility is expected. But if investors can absorb potential short-term drawdowns, historically as much as 50%, the upside potential is immense. Rick emphasizes the value of large cash-generating deposits and favors jurisdictions and assets that are currently out of favor. These are not speculative punts. These are disciplined plays based on long-term demand curves and energy transition dynamics. This kind of contrarian positioning is echoed in their retrospective look at uranium, a market that suffered a baseless panic over AI-related energy forecasts, only to rebound sharply. The lesson here is clear. In commodity investing, narrative dislocations often create the best entry points. As we pivot from copper to precious metals, Rick and Lobo revisit the gold and silver equities space, one that has matured significantly since its last bull run, but still remains broadly misunderstood by the market.
The thesis that the gold stocks were broken is one that was really a 2024 story. And I wrote about it just over a year ago, arguing that they weren't broken. But that, as my mentor Rick Rule taught us so well, the gold producers in the last big gold bull market managed to turn a sevenfold increase in the underlying commodity into an increase in negative free cash flow. And I went and charted that. It's true. So the intelligent investor, assuming there are two or three left still alive, it wouldn't be wrong for them to hesitate before saying, oh, gee, gold's up, gold stocks should go up. The last time, they turned it into greater negative free cash flow. Why would you buy that business? Or as my other mentor, Doug Casey, says, it's a crappy choo-choo train 19th century industry. Why would you invest in that today if your most recent experience with it is a dramatic underperformance? So flash forward to this year, and not only do we have the higher gold dollar exchange rate, I don't like to call it the gold price because in my mind, gold is money. So it's a Forex question. The higher gold dollar exchange rate, it's not just that has pushed up the miners. The miners have actually started delivering. Agnico, as you mentioned, known for excellence of operations, it actually was outperforming even last year. And the other ones that have problems, not so much. And that kept the GDX underperforming. Well, this year, even last year's underperformers are benefiting from the margins, and some of them are actually getting their act together. And so, I mean, it makes sense. The business is actually delivering. And so those people who previously said, well, the gold miners, they flubbed it last time. They dropped the ball. Well, this time they're actually running with the ball. There's a rational basis for saying that Well, now it makes sense. And then, of course, the food chain, the trickle down theory, that actually does work in the mining space. We've seen this repeatedly. So I will push back a little bit on my mentor here and say that the obviously better companies have responded with gusto here. So it's really difficult for me to look the audience in the eye and say, yeah, never mind $3,300, $3,400 gold in all-time highs, not just 52-week highs, but all-time highs in a stock like Agnico or something like that. Just buy it. It'll be fine. There is opportunity for correction. And the idea is to buy low, sell high, not to buy high and hope to heck to sell even higher. So as much as I love a company like Agnico, I would buy that today at an all-time high or very near to that. I would look for something that is legitimately still overlooked. And this requires due diligence. This is a stock picker's market now, is basically what I'm saying. I wouldn't buy an ETF. I wouldn't buy the GDX or the misnamed GDXJ. I would look for something that is legitimately bringing value to the market, which hasn't caught on yet. And those do exist. They're out there. But there are ones that you can't say, oh, it's cheap, so that's an overlooked gem. No, there are stocks that are cheap and they deserve to be cheap, right? Lifestyle companies and that sort of thing. So again, caveat emptor, buyer beware. This is a stock picker's market. But if you're willing to do a little work, and hey, if you want to make money, you should be willing to do a little bit of work, maybe a lot of work. I do think that there's still, I'm agreeing with Rick, there's still opportunities in the gold and silver stocks. But I do think it requires effort here, no dart throwing.
Well, I would respond to Lobo by saying it's always required effort. And what he says about the sector as a whole couldn't be more true. There's probably 1,000 public companies worldwide that purport to be in the gold space, but most of them only have gold as a component of the name on the share certificate. If a commodity rises that you have none of, it shouldn't impact your basic values. And the great majority of the purported gold mining stocks will ultimately return to their intrinsic value, which is zero. Investors make fun of sovereign issuers for inflating away the currency, but there's no industry in the world that's better at inflation, which is to say printing phony paper, than the gold mining industry. That disguises the fact that there are qualitatively better companies now than there were in the decade 2000 to 2010. Remember that the most flagrant abusers in that epoch were allowed to pursue other employment opportunities, hopefully in other industries. I would argue further, as an example, with Agnico Eagle, and we've done the work. If you do a net present value calculation on their future cash flows at $3,200 gold and compare it with the net present value of future cash flows that existed 18 months ago when the stocks were half as high, they're actually cheaper today than they were 18 months ago on a net present value basis. Both Lobo and I have the experience, we have the courage, and we're willing to do the work. So we can go down, further down the feeding chain than most people do. However, if we're talking to a broad audience, which I know the VRIC has, the truth is that most of the population underowns the gold trade. And just capturing the beta, just capturing the amount by which the gold market outperforms the broad market in a gold bull market, argues that investors who aren't willing to do the work, who can't suffer volatility, too much volatility, and can't suffer real risk, need to be in the best end of the market. Bull markets follow very, very predictable patterns. The metal, the best of the best of the rest. The junior producers, the developers, the explorers. That's the way it works. For myself, I'm moving way, way, way down the value chain. I'm trying to get as far away from the institutional investors, from the traders, from the ETFs as I possibly can, so that I can acquire large positions in companies that will be acquired and added to the index. That's the way the game works. But this is a game that requires a lot of work. And I have learned at my conference and your conference that most investors are unwilling to do the work required. Most investors would prefer to feel as opposed to think. For them, they need to be in very, very high quality names.
The narrative that gold equities are broken is rooted in past performance, specifically the failures of the last gold bull market, where miners squandered rising metal prices through mismanagement and ballooning costs. But as Lobo Tiggre points out, that narrative is becoming obsolete. This time, companies are demonstrating operational discipline, real margin expansion, and improved shareholder alignment. Agnico Eagle, for example, is delivering on both cost control and production targets. While it may not be a value buy at all-time highs, it exemplifies what disciplined management in the mining sector can achieve. Still, this is not a market for lazy capital. Both Lobo and Rick stress that this is a stock picker's market. Broad ETFs like GDX or GDXJ may no longer offer outsized returns. Many of the undervalued names are not even in the index. Investors need to identify genuine value. Companies with competent management, clean balance sheets, high-grade reserves, and a path to production or acquisition. That requires due diligence. It requires understanding which companies are lifestyle plays. Rick Rule reminds us that most so-called gold companies are nothing of the sort. In fact, many of them possess no economically recoverable gold and exist primarily to raise capital, not create value. He argues persuasively that most of these will eventually revert to their intrinsic value, zero. However, for the disciplined investor, there is another end of the spectrum. High-quality names with real economic value, some of which may be trading below their net present value at current gold prices. At $3,200 gold, many of these miners are not only viable, they're remarkably cheap. Ultimately, the opportunity in this sector lies in understanding market psychology, supply-demand fundamentals, and capital discipline. Investors unwilling to do the work should stick with the highest quality names to capture the beta of this bull market. But for those with courage, experience, and the willingness to dig deeper, the rewards could be outsized. If you found this discussion valuable and want to stay ahead of the curve in commodities and precious metals, don't forget to like this video, subscribe to the channel, and share it with others who understand the power of intelligent capital allocation in volatile times.